Everyone's calling for the dollar to break down, but what if the real trade is on the other side? Today, we're going to take a look at whether the US dollar is bottoming out, setting up for a tactical short squeeze that could catch the market completely offside. If you're trading currencies or watching macro, this one's critical. Before we dive in, if you want to stay ahead of the curve on macro trading and tactical option setups, hit that subscribe button. We break it down with real strategy, no fluff. Here I have a chart of that US dollar index, and as we talk technicals, we have to start off with the sentiment, which is decisively bearish. There is consensus view that the US dollar is going lower. Now, while we technically have a clear downtrend underway, lower highs, lower lows, but when positioning is extreme, you don't need fundamentals. You need flow awareness. It's not always about economics. It's about where the pain trade is. And right now, that might just be up. So let's talk technicals. First off, are there signs of a short-term bottom? Or is the primary trend still the one that is dominant? Well, absolutely, we can say that the downtrend has been intact. Lower highs, lower lows, rejection at the 50-day moving average persistently all year. And so we have a primary downtrend that every bear is leaning on. Now, let's talk about where the reversal points are. Now, first of all, we had these two updates in the last 2 days where we basically had this dollar upticking here. As that uptick is occurring, there's a couple of technical levels to watch. I'm just going to zoom in here a little bit. There's, first of all, the 98 level, which is roughly where the 50% retracement line is of the decline that we saw here over the last few days. And then we have that 50-day moving average just a little bit higher, around 98.50, which is where every single rally has been rejected all year. Now, if we saw a scenario where the US dollar broke these two levels on the upside, it is often what triggers the flows pivot, where a whole series of traders and short sellers that are getting squeezed out of their positions will actually create a short-term wave of buying that ultimately creates this feedback mechanism that it becomes this short squeeze or rip higher. Now, there is a primary downtrend in place that is still in the bigger macro scope, the big play in the bigger picture. Like, we could definitely see a US dollar that is down at the 90 level or lower by, let's say, middle of next year. But often what will happen is there will be midpoints, periods where you will get a rally that squeezes everyone out before a big continuation pattern later in the year. These squeezes are a very important and normal part of the market, and they often will occur when the sentiment is so decisively negative or bullish in the opposite end. And we are really at a very important level where that sentiment is so incredibly negative. Will these technical levels break is the thing to watch. Now, the next part that is important is to break it down by looking at the different currency pairs. And this is where I feel that this is where we get a much closer look at some of the things that are happening. And the single strongest showing of the US dollar against the majors has to be in the US dollar yen. So notice here that the US dollar was decisively in a downtrend going up until the April bottom that saw a substantial rise in the yen. Since then, we've saw an extended basing formation over the last 2-3 months establish itself on that US dollar yen. But more importantly, we saw the other week, we saw a breakout out of that prevailing trade range. Now, that entire retracement was a 50% retracement down to its 50-period moving average, a classic buy-on dip with these breakout candles showing right in here. This is poised for a potential strengthening of the US dollar against the yen. So let's go on and take a look at another really important pairing, the pound sterling against the US dollar. Now, there was a very decisive bull trend in place all year. Now, what we saw was a very early July high, a very decisive sell-off, and it's always technically worthy to see when this happens, where you have a classic buy-on dip occur here in June, a very decisive rally, but then a sell-off that wipes out the entire previous rally in one fluid motion. It was that included a breakdown below that 50-day moving average. Now we had a bounce off of that failed right at its 50% retracement and setting up for what could definitively be the right shoulder of a big head and shoulders topping formation. Now that doesn't have to be a new bear market in the pound sterling, but could be the beginning of one of these mean reverting corrections, one that, let's say, would have a 50% retracement that could see the 130 level on a pullback. This would be a second place to find the crack that could start a US dollar move. We then move on to look at the US dollar CAD, or against the Canadian dollar. And now, while we had a classic Eiffel Tower formation, basically a huge rally in that US dollar, and this year a wipeout that basically saw that entire rally given back in its entirety, we're now back to a very important trade range support line through 2024. A logical place from this now very oversold US dollar against the CAD that could be the base from which this starts to reverse. Now, we haven't seen any breakouts like we've seen in the yen, but this would be another place to be watching whether or not that squeezing is coming in. Now, then brings us to the most important pairing, the euro. The euro against that US dollar has been a leader during this move. And at this moment, out of all three of the other charts that I showed, this fourth one is the most bullish. It's been persistently higher highs, higher lows, holding up along its highs. And because of its weighting in the dollar index, has actually making it look weaker than it is when you look at those other pairings. This is a critical moment. If the euro can manage to break to a higher high, this could keep that US dollar downtrend going for a little bit longer. But for me, this is also a risk of a double top, especially in light of the way the other currency pairs are behaving. And so if we see that the euro fails along its highs, and more importantly does something similar to what the pound sterling did, wipes out the entire last rally back down to 116, where that 50-day moving average is creeping up, we could suddenly find ourselves where all of the majors have all reversed, and potentially seeing corrections in almost all of these currencies, driving that short-term US dollar squeeze. Quick pause. If this type of analysis helps your trading or your macro framework, give the video a like and drop us a comment below. So what's the key takeaway? While the trend is your friend and trading in the trend works for a while, you do need to recognize that the flows overpower the fundamentals at some point when a trade gets crowded. Watch these price levels, because if they hold or break, the entire narrative flips. Tactical setups don't care about the long-term debt story. They care about positioning today. The question isn't what should the dollar do? It's what the market's not ready for. That's where the opportunity lies. Make sure you subscribe to a free trial at Big Picture Trading with the links below. We have some tactical content coming up that you won't want to miss.